everyone, welcome to Chapter 3. You've made it. So we're moving on now, and we're going to be learning more about how the business's financial position changes. So let's think back to Chapter 2. The main topic in Chapter 2 you learned was how to prepare a balance sheet. And I told you that a balance sheet is a snapshot. It is a point in time. It is the financial position of the company at a particular point in time. And we know that if you created another balance sheet the next day or the next month or the next year, it would look different. And why would it look different? Well, the company would be making sales. The company would be buying products. The company would be paying employees. The company would be buying a new piece of equipment. And all of these things would happen. And these things are called business transactions. So this is a very important concept. Business transactions, okay, is a financial event that causes a change in financial position. So if something causes the financial position of the company to change, so either the company owes more money, the company's paid out some money, the company has earned some money, the company has suffered a loss, if any of those events happen, then that is called a change in financial position, and it means we need to record a business transaction. So let's say, for example, and I'm going to move me, let's say, for example, this example here, a business buys a new color laser printer for $700. My question to you is, what balance sheet accounts would be affected by this transaction? So I'm going to give you a second to think about this. What balance sheet accounts would be affected by this transaction? Try writing down what you think. So when you think about the balance sheet, we've got cash, accounts receivable, we've got equipment, we've got furniture, we've got accounts payable, we've got a bank loan, and we've got the owner's equity. So when we think about all of those different accounts that we have on our balance sheet, what two balance sheet accounts might be affected? Well, let's think about this. Well, if we buy a new color laser printer for $700, well, our equipment is going to go up by $700. And we have to pay for it, so it means our cash is going to go down $700. So office equipment goes up, cash goes down. Got it? Let's try another one. Example number 2. A business pays off $300 of their bank loan. What balance sheet accounts would be affected by this transaction? I'm going to give you 10 seconds to write down your answer. And really test yourself here. What's going to happen? All right. Did you say that the bank loan would go down and cash would go down? If you did, then you've got this. But let's try one more example to see that you've really got this. All right. A business has a fire inspector in to check the fire extinguishers. What balance sheet accounts would be affected by this transaction? So I really want you to think about this. Remember that I said on the first slide that it must change the financial position of the company. That's what a transaction is. Does this situation change the financial position of the company? If you said no, then you would be right. There is no business transaction here. The fire inspector does this. They are hired by the city of the whatever municipality they are in, and the fire inspector goes around and does this as a service to the general public, and the business is not charged for it. So this is not a business transaction, as the financial position of the business does not change. The business does not have to pay anything for this service. All right. So you need to understand the difference between a business transaction and a non-business transaction. And when we have a business transaction, we also have a new accounting standard that we need to make sure we understand. And this is called the principle of objectivity. And I would like you to write that in there. So principle, except for I can't spell. Here we go. Principle of objectivity. Okay? And this accounting standard says that a business's accounting be recorded on the basis of clear, verifiable evidence. I want you to think about this as, for in most cases, third-party evidence. And this means that different people, so if I was looking at this piece of evidence and you were looking at this piece of evidence and someone else was looking at this piece of evidence, that all of these people would arrive at the same values for the transaction, so that it's objective. It means that no one had to use their personal opinion or feelings to determine what was going on here. It's based on fact. Okay, it's based on facts, based on the clear, verifiable evidence. So, what does evidence look like? Well, evidence is we use in accounting something called source documents as our evidence. So source documents, you've probably not heard this term before. A source document is but you've actually had lots of source documents. It's a business paper that has a dollar figure on it that causes a change in financial position to the recipient, in this case to the company. Okay? And so these can be lots of things, and you've seen these before. A hydro bill is an example, a check. Okay, so when a company writes a check to pay for something, there's a second copy of that check that's maintained at the business, and that shows what has been paid. There's store receipts, so when you go to Target to get gas, or when you go to the dollar store to buy something, you're getting a store receipt. That is a business paper that has a dollar figure that would be changing your financial position. A business would have a sales invoice when they sell something, and they would also have a purchase invoice when they make a purchase from their supplier. So let's look at a couple of, let's look at one example. I don't think I have a couple. Later on we have a couple. I don't know where to put me, so I'm going to hide me. Okay, so this is an example of a sales invoice. Okay, and who is it a sales invoice to? Well, it is a sales invoice to Computing Edge. So this is the company that has made the sale. This is the company that has made the sale. Made the sale. So what's going to happen to this company's financial position? Well, let's do this. The company's here, a client owes $400. So they haven't paid it yet, so accounts receivable goes up and owner's equity goes up because the company is in a better financial position when they make a sale. Now, the person receiving this invoice is a client. So for this company, a client, this is considered a purchase invoice because they have made a purchase. So they would keep this invoice on file. So there'd be 2 copies of the invoice. Computing Edge would keep 1 copy and a client would keep the second copy. And so for these guys, what accounts are affected? Well, they've bought a web page design. Okay, so maybe, and they've done some scanning. So maybe we're going to, and they owe this money. So accounts payable is going to go up because they owe this money. And it's an expense, which means that owner's equity goes down. The company is in worse financial position for having this service done. And that's not a bad thing because sometimes the web page, maybe that's going to attract more customers. So that's a good thing. Now I want you to notice here, the invoice, every invoice has an invoice number, okay? And so an invoice number allows me to see and track this, so it's easier for filing. And it always has a date on it, okay? So when the sale has taken place. And it also always has the terms. This means that this invoice is due, this $400 is due to Computing Edge within 30 days. Hopefully you've written all over this invoice just like I have. I want you to know this stuff. Okay, so we need to remember a couple of things. First, we need to remember that accounting entries are made from business papers known as source documents. So receipts, sales invoices, purchase invoices, check copies, and so on. And source documents are kept on file. This is very important. So all source documents are kept on file for reference purposes, and they are proof that the transaction existed. We call this a paper trail in accounting. So if I look at the balance sheet and I see that equipment has gone up by $500 last year, and I want to see what was purchased, I can go to the accountant and say, can you show me what assets were purchased in equipment last year? And they should have a file folder that shows the invoice. That's what we call a paper trail. Okay, so steps in analyzing a transaction. Step number 1 says that we must identify all the accounts that are impacted. And the accounts are going to determine, you're going to determine our assets or liabilities. And these are the accounts that would be impacted by the transaction. Step number 2, we need to determine, has owner's equity changed? Has owner's equity changed? Okay, you're going to ask yourself that question. And then some subsequent questions to be able to figure this out. Is the company better off? If the answer is yes, then it's an increase to equity. Okay, is the company worse off? If yes, then it's a decrease to equity. Step number 3, you need to make certain that at least 2 of the individual items have changed. So a minimum of 2 accounts must have changed in order for the business transaction to work. Because again, we want to make sure that the equation is still in balance. Assets equals liabilities plus owner's equity. So if we record the change that asset has increased by 500 and we don't record any other change, does this still hold true? No, it doesn't. So we want to make sure that, let's say if the transaction is that the company bought some furniture on account, meaning that they are not paying for it right away, well, assets go up by 500 and liabilities go up by 500, and there is no change to owner's equity. Now the equation is still true because the left side of the equation and the right side of the equation have both gone up by $500. Thank you so much for listening. I know this was a long one. Tomorrow, what I'm going to have you do is a little practice to see if you understand business transactions. So thank you for listening, and we'll see you tomorrow.